Hey everyone, welcome back to your daily source for everything happening with the British pound. Today is December 23, 2025, and the pound is stealing the headlines after the Bank of England's final interest rate decision of the year. Just days ago, on December 18, the Monetary Policy Committee voted to cut the UK base rate by 25 basis points down to 3.75%. But instead of the usual post-cut weakness, the British pound has staged an impressive rally, pushing GBP USD firmly above the 1.34 level. It even touched intraday highs around 1.345 in thin pre-Christmas trading, a counterintuitive move that has traders buzzing.
It's the perfect story to close out 2025 while setting the tone for what could be a very interesting year ahead in 2026. Let's start from the beginning and unpack exactly what went down at the Bank of England. The vote was extremely close. 5 members supported the cut to 3.75%, while 4 members voted to hold rates steady at 4%. That narrow majority is a big signal in itself. It shows deep divisions within the committee about the pace of easing. The Doves argued that the economy needs more support given the lackluster growth numbers, while the Hawks remain worried that inflation could prove stickier than hoped, especially in the services sector and wage growth. Adding to the picture, the latest inflation reading for November came in at 3.2%, which was notably cooler than the 3.5% that many economists had penciled in. This drop was helped by falling food prices, slower energy cost increases, and early discounting from retailers ahead of the holiday shopping season. At the same time, the Office for National Statistics confirmed that GDP grew by only 0.1% in the third quarter, and most forward indicators point to essentially flat or even slightly negative growth in the fourth quarter. So the UK economy is clearly in a soft patch, not quite in recession territory, but definitely lacking momentum. Now, here's where it gets really interesting for the pound. Normally, when a central bank cuts rates, the currency takes a hit because lower interest rates reduce the appeal for foreign investors seeking yield. But this time, the market reaction was the opposite. Why? Because the accompanying statement and meeting minutes struck a much more cautious tone than many had feared. The Bank of England essentially pushed back against aggressive market pricing for multiple rapid cuts in 2026, emphasizing a gradual and careful approach to further easing. That less dovish than expected guidance caused traders to unwind some of their short positions on sterling and reduce bets on deep rate cuts next year. Combined with relatively thin liquidity in the markets as we approach Christmas, this shift in sentiment was enough to spark a sharp short covering rally. GBP USD broke through several key technical levels, reclaimed the 1.34 mark convincingly, and has held those gains even as we move into the quieter holiday period. If we zoom out and look at the broader context, the pound's resilience this year has been one of the standout stories in the currency markets. Despite facing headwinds like political uncertainty earlier in the decade, post-Brexit adjustments, and now a sluggish growth outlook, sterling has managed to hold its ground better than many other major currencies against the dominant US dollar. Part of that strength comes from the fact that the Bank of England was slower to start cutting rates compared to peers like the European Central Bank or the Bank of Canada, giving the pound a relative yield advantage for much of 2025. The recent rally reinforces that narrative and suggests that as long as the BoE maintains a measured approach, sterling could continue to benefit from policy divergence with other central banks. Let's talk about the real-world implications because that's what matters most to everyday viewers. For anyone with a mortgage, especially those on variable or tracker deals, this cut will eventually translate to lower monthly repayments once lenders pass on the reduction, offering some breathing room after years of elevated borrowing costs. Home buyers coming off fixed-rate deals in the coming months might also find slightly more favorable refinancing options. On the flip side, savers are feeling the squeeze again. Interest on cash savings accounts and fixed-rate bonds will continue to drift lower, pushing more people to consider alternatives like stocks, bonds, or even just spending rather than hoarding cash. If you're planning any international travel or sending money overseas over the holidays or into the new year, the stronger pound right now is great news. You'll get more dollars, euros, or other currencies for your sterling compared to just a month or two ago. Businesses that rely on imports priced in dollars will see their costs ease a bit, while exporters might face a slightly tougher environment as UK goods become marginally less competitive abroad. Looking ahead to 2026, the outlook for the pound feels cautiously optimistic. Major forecasting houses like Barclays, HSBC, and Goldman Sachs generally see GBP USD trading within a 1.33 to 1.37 range over the next 12 months, with upside potential toward 1.40 in more bullish scenarios if UK data stabilizes and the Federal Reserve delivers more aggressive cuts than currently expected. Key things to watch will be the February and May monetary policy reports from the BoE, upcoming inflation and wage numbers, and any shifts in fiscal policy from the government. On the global stage, developments around U.S. trade policy under the incoming administration, commodity price movements, and geopolitical risks will all feed into dollar sentiment and, by extension, influence sterling's performance. While risks remain on both sides, the pound enters the new year with decent momentum and a narrative of relative resilience that could support further gains if the data cooperates. To bring it all together, the Bank of England's narrowly decided 25 basis point rate cut to 3.75%, combined with cooler than expected inflation, a cautious forward guidance tone, and thin holiday markets, has delivered a welcome Christmas rally for the British pound, lifting GBP USD comfortably above 1.34 and signaling underlying strength as we head into 2026. Whether this sets the stage for a sustained move higher will depend on the incoming economic data and central bank actions on both sides of the Atlantic. But for now, sterling holders have reason to feel a bit more cheerful. As always, please remember that this video is for informational purposes only and is not financial advice. Currency markets are volatile and past performance is no guarantee of future results. If you enjoyed this deep dive, give it a thumbs up, share your thoughts in the comments about where you think the pound is headed next year, and don't forget to subscribe and hit the notification bell so you never miss an update. Thanks so much for watching, have a fantastic holiday season, and I'll catch you in the next video very soon.